Thank you, Andrew. Hi and good afternoon to everybody who is in attendance today. My name is Sharif Abdu. I am a senior analyst here at Valleyline. I am joined today by two other senior analysts, Alan House and Charles Moran. We here at Valleyline hope that you and your family are staying safe and dealing with this difficult time as best as possible. So, today we're going to provide an update on the coronavirus and its ongoing impact on the economy and the stock market. We will also discuss the actions that Valleyline is taking to help our subscribers navigate this difficult time. We will then recommend one stock to buy right now, and we will also be taking any questions that you may have. Please note that this presentation will be available on our website. That's valleyline.com. And it will also be available on our YouTube channel within the next 48 hours. Also note that any previous webinar is also posted on our YouTube channel. So before I jump into the heart of the presentation, for those of you joining us for the first time, I want to provide just a brief overview of who we are at Valleyline. So Valleyline is a New York headquartered corporation. We have been providing investment research for more than 85 years. Our flagship product is the Valleyline Investment Survey. This service is a unique source of financial information. It's designed to help investors make informed investment decisions that fit their individual goals and levels of risk. The product includes data, information, and analysis on more than 1,700 equities that trade on the New York Stock Exchange, the NASDAQ, as well as the Toronto Stock Exchange. Our service also includes economic commentary, easy-to-follow model portfolios, stock screens, industry-based analysis, and much more. The service is published weekly. And it's created by Valleyline's research department, which includes more than 70 analysts, economists, data experts, and quantitative specialists. One thing that I want to stress right now is that our research is completely unbiased and independent. So unlike many Wall Street brokerage firms, Valleyline has no investment banking business with any company, and that includes the 1,700 that are included in this service. Valleyline does not execute trades for its subscribers, and therefore we have no vested interest in whether our subscribers buy, sell, or hold any specific equity. What's more, our staff of professional securities analysts are not permitted to own shares of any company that they cover. If you have any questions about the products or services that we offer, or our different tiers of subscriptions, that information can be found at ValueLine.com, or you can also call 1-800-ValueLine. So that's ValueLine.com, or you can call 1-800-ValueLine. So I'm going to touch very briefly on the coronavirus, the economy, and the stock market. And I will be referencing content that was prepared by Harvey Katz, and Harvey is Valleyline's chief economist. Okay, and here is Harvey's commentary. President Biden faces daunting challenges as he begins his term. First, there is the need to address the sharp divisions that weigh on our country, spotlighted by the former president's second impeachment trial. Second, there is the fight against coronavirus. That disease has claimed more than 400,000 U.S. lives and affected the fortunes of millions of Americans. Finally, there is the importance of getting the economy going again and of securing a new stimulus package along the lines that Mr. Biden envisions. Economic woes are mounting. True, we aren't reeling to the degree that we were last spring when GDP cratered. Still, lockdowns have multiplied along with infections, and retail sales are off sharply, with the drop especially severe if we exclude auto sales from the mix. Also, employment is down and weekly jobless filings are up. Clearly, it will take time to get the economy going again. But for now, we expect little or no growth this quarter, and a double dip, recession is not out of the question. The expected more rapid rollout of the COVID-19 vaccines should help. Still, even with this assistance, the pain resulting from the spike in infections, hospitalizations, and deaths, as well as the growing list of cities and states suffering with lockdowns, curfews, and other restrictive measures, could make it a number of months before we see any significant improvement in the economy. Amidst these challenges, fourth quarter earnings season is up and running. To date, results have generally topped weak forecasts, and we expect this pattern to continue. With price-earnings ratios high, a decent showing may be needed to sustain, let alone lift, the market from its lofty perch. The bulls are still a force to be reckoned with. Additional records have been set on the major averages as optimism builds that a more collegial tone will be sought in Washington. That will be difficult, of course, but such an attempt is worth making. Conclusion. Given the extended levels of the stock market, much of the optimism being seen will need to be realized. That will be a formidable task, but with competing investment vehicles generally less attractive, holding quality companies with favorable earnings prospects is still appropriate. Please refer to the inside cover of the Selection and Opinion for our statistically based asset allocation model's current reading. So that was the current economic view written by our chief economist, Harvey Katz. I just want to touch on one sentence from Harvey's write-up, and I quote, "But with competing investment vehicles generally less attractive, holding quality companies with favorable earnings prospects is still appropriate." So that has long been Valleyline's perspective, right? That equities should be a core component of any well-rounded, well-diversified portfolio. You know, that's whether that's in good economic times or less favorable times, bull markets, bear markets, equities should be a core holding in investment portfolios of all stripes. The economy, both in the U.S. and abroad, it's still in a weakened state, and it's going to take a while before we see a meaningful recovery. So on that note, Valleyline is providing a great deal of information and analysis to help our subscribers. We know that most of our users depend on our weekly stock reports, our time-tested ranking systems, and other valuable services. In addition, Valleyline provides a great deal of daily content. They can help you avoid the pitfalls, right, and help you profit during this volatile time in the stock market. Every business day, senior members of Valleyline's research department review the most actively traded stocks, company press releases, news stories, trade periodicals, and other sources for data and information that may change our view and investment recommendations for specific stocks. When something noteworthy does cross our desk, we immediately publish a supplementary report. Alan, I don't know if you want to take us to the homepage and show people where they would access these supplementary reports. That might be helpful. I think you can get that on the dashboard. So as you can see there, we publish these supplementary reports, and these outline new information and more importantly, what it means for the stock and for shareholders. This content is posted throughout the day on our website, and again, that's at ValueLine.com. I will show you now how you would access the website. Alan, you don't need to log out, but you can just maybe sort of mime the process of how it is that they would log in. Just once again, typically what you would do is you would go onto our dashboard where we are located right now. This is the main landing page for subscribers. Under the quick links, you can see that we have supplementary reports. We have summary and index. We have the SMC, that's a small and mid cap. There's all different types of content that's provided both on a weekly and on a daily basis. So obviously, equity markets have been very volatile over the past year or so, and we are aggressively adjusting our financial strength grades. Individual companies are dealing with sharply reduced demand for their offerings and supply chain problems, among other issues. Consequently, corporations have been implementing cash-saving initiatives such as headcount reductions, slashing of advertising budgets, and reducing or outright eliminating their dividends. Taking on additional debt has also been popular as a means to build cash in anticipation of difficult times ahead. Due to the rapidly deteriorating balance sheets of certain companies, Valleyline has been reviewing and altering our proprietary for financial strength grades for the stocks in our coverage universe. These changes are posted each week in our selection and opinion newsletter. Since there were so many changes over the past year, we have emailed out the list to our subscribers each Monday. For those of you who don't know, financial strength, along with price stability, which is another proprietary Valleyline measure, are the two metrics that are used to calculate a stock's safety rank, which is a very key, very important measure of risk. When considering a new stock to invest in, we strongly suggest that you utilize financial strength and safety in your decision making. That's, I can't emphasize that enough. Financial strength and safety should be something that you very seriously consider and factor into your investment decisions. For more information in regard to our proprietary ranks and ratings, Valleyline provides a user guide that can be accessed via the investment education section of our website. Lastly, this is a good time to mention that the case for individual stocks is still quite strong, right, over broad index funds. Certainly, particular industries and sectors will recover more quickly than others during this and after the pandemic runs its course. Okay, so with the we'll get to know each other, that portion out of the way. Now we can talk about the screener. So, Alan, do you want to take us to the stock screener, please? Okay. I'm going to walk you through the screening process and different ways that you can approach this. Today, we're going to start the screening process by looking at the timeliness rank of an industry. Okay, so one way to attack it is, what industries do we think are going to perform well, let's say in the next 6 to 12 months, right? Instead of trying to pick an individual equity, why don't we attack it from the direction of what industries do we feel are going to be market outperformers, let's say in the next year. So for right now, we're going to use one screening criteria, that is the timeliness rank for an individual industry, and we're going to go for a rank of 10 or better. Okay. I'm just going to jump back one step for just a moment. Alan, you can stay right there. So for those of you who are not familiar, Valleyline's proprietary timeliness ranks, when applied to individual stocks, it's based on our projections for share price movement in the next 6 to 12 months, right? It's ranked on a pretty simple scale. It's from 1 to 5. Stocks with a rank of 1 are expected to be the best performers in the coming year relative to the performance of the broader market. Stocks with a rank of 3 are expected to mirror the market in the near term, while stocks with a rank of 5 are expected to trail the broader market. All right, makes sense? Pretty simple scale, 1 to 5, 1 being the best, quote unquote, and 5 being, let's just say, the weakest. So there are 1,700 stocks in the Valleyline Investment Survey. The Valleyline Investment Survey is our flagship product, and there are 1,700 stocks within the coverage universe of the Valleyline Investment Survey. Those 1,700 stocks are housed within 96 different industries. Okay, so we take the 1,700 and we break them down by, we sort of filter them within those 96 industries. So, for example, you have financial services, you have apparel, you have hard lines, you have defense, you have REITs or real estate investment trusts. You have all different types of industries, and we filter those 1,700 stocks. They're all housed within, one of those 96 different industries. So within the context of an industry and its timeliness rank, it's ranked on a scale from 1 to 96. It's a similar concept to the timeliness rank for a stock, right? The timeliness of 1 for an industry, it's expected to be the strongest performer in the year ahead relative to the market, while an industry with a rank of 96 is expected to be, let's just say the weakest performer in the coming year. And anything between, it's going to fall somewhere, somewhere in between 1 and 96, somewhere between the strongest and the weakest. Okay. So today we are looking at what we expect will be the 10 industries that will be the strongest performers in the coming 6 to 12 months. So already Alan, if you can scroll up just a little bit. So already we've whittled our list down to 438 cumulative matches. Okay, we started with the entire ValueLine coverage universe. That includes the ValueLine Investment Survey, that includes the SMC, which is a small mid-cap, that includes everything under ValueLine coverage. It's 5,700 companies. So it's a pretty daunting number. But just by applying this one screening criteria, we've already whittled that down to 438. So good, we've made some progress. And obviously, you can fine-tune that to whatever your specific needs are, whatever your specific criteria is. You can make it an industry rank of the top 5 industries in the next 6 to 12 months. You can make it of the top 20. You can make it just the top 3. You can fine-tune that to any, whatever your criteria would be. So we're down to 438. We want to filter that down even more. We want to get that list down even further. So what I'm going to look at now is appreciation potential for individual stocks in the next 18 months. Okay, so we're going to, as Alan is showing you right now, we're going to look at the 18-month TPR midpoint. And basically what that means is we're looking at equities that have the, within the next 18 months, we expect that the midpoint of their price action, the midpoint within the next 18 months is going to be, we're setting the bar today at 20%. Okay, so we expect appreciation potential of at least 20% within the next 18 months. And Alan, if you want to filter that, let's see. Okay, so we've got it down to 40. So we started out with 5,700. Alan, can you scroll up a little bit, please? All the way up to the top, please. Okay, so we started out with 5,700, right? So it's a pretty big number, almost kind of hard to wrap your head around that many different equities to go through and to decide what type of investment choice you're going to make. We started with 5,700. The first criteria got it down to 438. The second screen got it down to 40. So let's apply a qualitative criteria right now. We've got it down to 40, but let's apply something qualitative. So we're going to look at the safety rank today. And as I touched on earlier, safety rank is one of the most important ranks that prospective investors should consider when trying to decide an investment decision. Safety is one of a very important metric to use. So today we're going to look at stocks with a safety rank of 3 or better. So that would be stocks that are ranked 1, 2, or 3. So we've got the list down now to 35. Pretty good. Down to 35, but we can do better. So Alan, if you want to scroll down a little bit, okay. We're also going to apply another measure of, let's just call it security. So Alan, let's go ahead and let's take a look at financial strength. And today we want stocks with a rank of A++ or A+. Okay, now we're getting somewhere. So why apply safety and why apply financial strength, right? Why do those risks measures, why do they matter? So there are loads of risk measures out there and several that Valleyline offers, but today we chose to apply the safety rank because it is an aggregate score of total risk of a stock. And it's arranged on an easy to understand scale from 1 to 5, 1 being the most conservative issues and 5 being the most, let's just say, maybe it's a little bit high risk, high reward type of thing. I also want to highlight the fact that stocks ranked favorably for safety have in the past held up far better than the broader market during corrections and downturns. Okay. At the same time, they also meaningfully participate in up markets. So that's something to just keep in mind. So that's safety. What about financial strength? Why are we also applying financial strength in addition to safety? Due to the current economic environment, balance sheets have greatly weakened. As a result, loads of companies are reducing headcount, they're taking on more debts, they're reducing or outright eliminating their dividends. That's something I touched on before. Basically, by applying financial strength in addition to safety, we're doubling down. We're doubling down on security, we're doubling down on stability. We want issues that are companies that are built to withstand maybe a little bit of tumult, okay? So we've got our list down right now to 6, right? We started with 5,700, now we got it down to 6 finalists. And you can certainly make a good argument for any of the remaining stocks. However, today, our one stock to buy right now, and that's after consulting with a number of our senior analysts, we prefer and recommend VMware, and the ticker symbol is VMW. Alan, if you want to go ahead and click on VMware. Oh, actually, Alan, before we click on VMware, let's show our subscribers. Let's go back one step. My apologies, Alan. Let's go back one step. I think we didn't save it. Okay, that's my boo-boo. That's not Alan's boo-boo. So just so our participants would know, where Alan is showing you right now with the cursor, if you are happy with the screening criteria that we just applied or that you may have chosen for yourself, you can actually save that screen. You can save the screen and you can name it whatever you like. So for instance, today we could say, you know, industry rank, TPR, 18-month safety and financial strength. Just something, you can name it whatever you like, but you can save that screen for future reference. You can save that screen to come back for it at another date. It's just, it allows you to come back and you can save that screen for the future. So since we made that boo-boo, Alan, why don't you go up into the top right there and just manually put in VMware rather than making our participants have to sit through this whole process again. So as you can see right now, we're on the landing page for VMware. This is sort of the home page, if you will, for the whole company. Alan, can you scroll up to the top there so we can see the top bar? So if you want to start at the left there and show them the most recent price, we can see that the stock is currently trading at about $140 a share. The 3 to 5 year target price range, 175 to 265. So the stock still has good appreciation potential 3 to 5 years out. And if you go ahead and look all the way across the top there on the right, you can see the 18-month target price range for VMware. It has a low of 104, a high of 251, and at the midpoint, it should appreciate about 20% in the next 18 months. So, you know, it has good appreciation potential both in the, let's call it intermediate term, about 18 months, and in the long term, 3 to 5 years. So let's talk a little bit about the company. Alan, if you want to click on our latest full page report. So we see that VMware, Alan, if you can make that page a little bit bigger so people can maybe read the blurb, the business blurb, so they can get, that's perfect right there. That's good. Okay, so VMware, it's they provide virtualization software. So what does that mean, virtualization software? So this allows companies to aggregate multiple servers, storage infrastructure, and networks together. Okay, and that allows them to make shared pools of capacity. As you can see in the statistical array, which is the center of the page, where we have sort of a graph, a chart, I should say, of all the different historical data, and we can see revenues, operating margin, depreciation, net profit, et cetera, et cetera. We expect revenues and share earnings for VMware to advance 11% and 10% respectively in 2021. So we expect pretty good appreciation both on the top and bottom line in 2021. So what's driving that? What's driving it for VMware is that they have strong demand for cloud-based services in the enterprise space. In addition, there's a growing proportion of the company's business is through subscription services and software as a service. So for those of you who don't know, software as a service, commonly it's referred to, if you're reading an article somewhere, the Wall Street Journal or the Financial Times, you'll see SaaS, and that's software as a service. Think of Adobe, right? You want software that allows you to edit, it's video editing software or it's photo editing software. It's for creative content. Adobe, companies like Adobe have been sort of gravitating and moving towards away from selling you a hard physical copy of that software to selling you a subscription service. The benefit of that for companies such as VMware and Adobe is that subscriptions and software as a service, they tend to generate higher margins, which is very good. And it's a recurring, steady cash flow, which is obviously very beneficial. So if we look at some of the metrics for VMware, pretty solid across the board. Alan, if you want to scroll all the way up to the top. So if we look at the box in the top left section of the report, we see that it has a safety rank of 3. It has a timeliness rank. The actual current timeliness rank is 3. This report is from November. The current timeliness rank for this company is a 3. Safety rank is a 3. Alan, if you want to go down to the financial strength box at the bottom there. So we see that the company has a financial strength rating of A+. It's very solid. It also has very respectable score for earnings predictability of 100. Not so great on earnings growth persistence, not so great on the price stability, but earnings predictability 100. Financial strength A+, safety 3, so pretty good. So what is the sort of the elevator pitch? What's the 30-second pitch for this company and for this stock? It has strong appreciation potential, both in the intermediate term and in the long term. In the next 18 months, we expect it to appreciate about 20% in value. In the next 3 to 5 years, we expect it to appreciate maybe about 55% in value. Alan, if you want to go all the way to the top there. So if you look at the current price, I think we said it was about $140. And if we look at the projections box, 2023 to 2025, Alan, if you want to sort of hover around that area to show our audience what it is. Okay, so you see the projections box there. That's our 3 to 5 year target price range. And it's a high of 265, a low of 175. The stock's currently at about 140. So if we look at the midpoint, in the next 3 to 5 years, we expect it to appreciate about 55% in value. So that's, pretty solid appreciation potential. All told, we think that VMware's position is quite strong. And we think that the stock can form one of the building blocks of a successful portfolio. And it is today's one stock to buy right now. Okay, thank you very much for sitting through that. Alan and Charlie, I'm going to go ahead and turn it over to Charlie actually at this point. And we're going to present a little something extra today. So I'm going to turn it over to Charlie and let him take the wheel.
Thank you. Thank you. My name is Charlie Moran, Senior Analyst at Valleyline, and in addition to recommending VMware, which we think obviously would make a fine holding for most investors, particularly those who employ a relatively conservative strategy, we also wanted to provide a stock that may offer the same magnitude of returns without taking on a lot of additional risk. And after evaluating our coverage universe and conferring with a group within the research department, we like the prospects of the ADR Ericsson, ticker ERIC. Ericsson is one of the leading providers of information and communication technology to service providers around the world. The company enhances the value of connectivity by creating sophisticated technologies and services that are easy to use, adopt, and scale. And on the heels of a likely healthy sales and earnings increase in 2020, we look for a single-digit top-line advance to drive strong double-digit share net increase in 2021. As a matter of fact, I believe they are due to set to release earnings tomorrow on January 29th. The company is poised to benefit from the continued rollout of 5G technologies, while its leadership position in the industry ought to help boost its market share. Again, we look for healthy sales in China to continue to offset sluggishness in Latin America and Africa. The company derives a little over 2/3 of its revenue from its telecom equipment and is poised to take advantage of the rollout of the 5G technologies. If you can look to the screen there, Alan, maybe enlarge Ericsson's page. Thank you very much. So we can read it a little better. Thank you. And company has solid relationships with many providers who must modernize networks to compete. And we think that the rollout of 5G will be a pretty prominent theme for investors this coming year and support a reasonable valuation. One caveat is the political landscape. Huawei is a competitor in some equipment products and has various degrees of access to Western markets. We do not think that situation is as worrisome as it appears at first glance, though, given the political landscape. For one, the two companies make many complementary products, and moreover, Ericsson's sales into China have stayed strong through the recent trade disputes of the last administration. The fundamentals are further supported by improved pricing and larger profitability thanks to better cost discipline. Separately, the relative valuation is below its recent level, and the balance sheet is less levered thanks to improving cash flows, and we thought that that was an additional pick to consider to generate healthy returns in the coming year. We were going to take some questions. If you have any, please post. And I was going to take the first question, which was regarding climate change and ESG. That I can answer briefly, just stating that we are going to have a climate change product very soon, potentially in the spring. And I would look for that product to come out, in the coming weeks. Additionally, there was another comment, I believe it was from Ida, who mentioned Merck, which we spoke about last, and if we still liked it. And I did want to say that we still favor Merck. The prominent product, Keytruda, has a bright future. The patent cliff is until 2028. Stock is extremely cheap relative to its historic valuation, and we see no issues with regard to the pipeline. And even though I believe there was a bit of a hiccup earlier this week, they said that they were going to suspend further research on a potential vaccine for COVID. That's probably a blessing in our eyes that they won't be devoting further resources to that. And I don't know necessarily that that would have been a boon to them, given the fact that others in the vaccine have not been necessarily rewarded if you look at the case of Pfizer. So all in all, we do still like Merck and believe it to be cheap and the dividend to be extremely secure and ample. So let's see what else in terms of questions and answers here. Alan, do you see anything there? Are you open?
Yeah, I see a good question by Pierre, who asks, is the industry ranking a lag indicator as opposed to a leading indicator, as you are mentioning? And actually, Pierre, the industry ranks are both. See, we have a proprietary ranking model, and it is somewhat lagging, but there are also some indicators that are leading indicators. So to answer your question, it's kind of a mixed bag, so to speak. There are some variables you use that are based on some forward-looking indicators. So yes, it's kind of a blend of both. And so, I hope that answers the question, that it's kind of a blend of both past performance and projected future performance. If an industry has good prospects, for the next couple quarters, then that will be factored into the timeliness rank. So there is some, qualitative measures as far as that's concerned. Thanks.
Okay, I saw one from Helen who had a pretty basic question, but it's probably one that is very important to consider, especially if you're new to the market. But she asked, what is the relative PE ratio? And if we could look at Ericsson, the page, I don't know if you can scroll up, Alan, a little bit further to get to the page where it has the array and the 3 to 5 year relative page, the relative ratio. You can see that is 0.90 in the far right-hand column. It is right beneath the average annual PE ratio. And what the relative PE ratio attempts to measure is the premium or discount of the company's market multiple relative to the PE multiple for the ValueLine universe as a whole. And so, as you can see, Ericsson is typically traded at a bit of a discount to the market. If you go back in the array back to 2004, you can see that it's kind of hovered around 1.00. So that can mean that during times when the multiple was extremely compressed, perhaps in the lower teens, it would just have maybe a discount to that would, be relative to what the overall market is selling for. Conversely, right now we're in a period where the market PE is hovering around 20, and you can see it has maintained the relative PE of 0.94 on the very top of the page, which is also a discount. So it's attempting to project the relative valuation to the overall market. Let's see if there's anything else here. Do you see anything of note, Alan, in terms of further questions?
Yes. Jack asked, how is an industry screened within the top 10? Is it because the industry contains companies that are highly ranked? And Jack, I would say the short answer to that question is yes. I mean, generally, for a industry to be ranked highly, it will have a lot of highly ranked stocks. That's not always the case. Sometimes there will be it'll be skewed kind of towards the top, but doesn't mean that all the stocks within the industry are highly ranked. But the answer to that is generally yes, that most of the time an industry is highly ranked is because most of the stocks have favorable ranks. There are exceptions, but in general, that's the case. Charlie, you see anything else that catches your eye?
Yeah. Jackie just mentioned, that I don't know if it's Jackie Reed, I believe, mentioned that is it a relative valuation compared to the industry or to the market as a whole, and why not the industry? The problem with that is that you're going to have situations where you don't have uniform businesses or operations within an industry. Not everything is as easily divisible, like Nokia and Ericsson and Huawei is to the telecom equipment space. I mean, even in a basic industry such as Coke and Pepsi, obviously Pepsi has the bulk of their profits from snack foods. So rather than them even being misleading with regard to comparing to the industry, we have to do it to the market as a whole. Let's see, anything else that I've come in contact with here. Alan, is there any other things that you see?
Helen asked, what is the relative PE ratio? And that's another good question. That basically measures the PE ratio of the company compared to the overall market. So let's say, for example, just picking numbers out of the air, let's say the market multiple is 18 right now and a company has an 18 multiple. The relative multiple will be 1.0. If it's lower than that, it'll be below 1. If it's higher than that, it'll be above 1. So it's basically how the PE stands against the broader market averages. And of course, some industries will have, historically will have higher PEs than others. Like a utility will most likely have a much lower PE than a tech company, for instance. So it's kind of, it's kind of just for comparison purposes, a lot of times relative to the historical averages, but sometimes it's like not comparing apples to apples if you look across industries. But within a particular industry, I think it's a good measure to see how a stock is valued relative to the overall market. So, Charlie, do you have any other?
I got another question from Randy, just an overall question regarding how the 1,700 stocks are selected, and obviously there are a whole host of issues that really go into the selection process, but one of the main priorities is getting stocks that come public that are very large. That would be the first criteria, but also really the volume, the daily volume of trading and the interest in those stocks. Those are the primary considerations, and we take from the expanded survey, which we also offer, that doesn't have analysis by individual analysts, but does have a very, similar historical array and statistics that are basically the same as one would get in the regular ValueLine investment survey of the 1,700 prominent stocks. Let's see. Just kind of looking around here further, I didn't see anything else. Alan, do you see anything of note?
Well, yeah, just a couple of people comment. I just want to say in general that, these particular individual reports were printed in November 6th and December 11th, respectively. And we provide updated reports as news comes out on the companies via supplementary reports. So our outlook can change based on, current earnings and fundamentals, et cetera. So I just wanted to point that out, that these reports, are based on how we saw the stock at those particular dates and times. So, but there also may be some supplementary reports or earnings. Like Charlie said, I believe Ericsson is reporting earnings tomorrow. So Yeah, that will provide a more updated outlook when that's available. Charlie,
Steve
you have
had a
any
good
other questions?
Yeah. I got a question from Steve recently asking about the times where we suspend the timeliness rank and the factors that go into it, and if it's temporary or permanent. Basically, what will happen when the rank is suspended, it's usually temporary when something happens along the lines of an announced acquisition, and we don't have the financials, and you know, if it's going to alter the prospects for the company and severely alter the composition of their operations, we're going to suspend the timeliness rank because it'll often alter the earnings projections and estimates that we have. And also, as far as its permanence, typically it'll be resolved once, in this case, a acquisition has been finalized and completed, and we will restore the rank at that time. Let's see, anything else? And yes, the small mid-cap survey is the expanded survey. We got that question as well. That's about it in terms of what we've received. Alan, do you see anything of note?
I don't see any other questions that we haven't addressed that stand out. I just would like to add that if you'd like to subscribe to ValueLine, you can call 1-800-ValueLine or subscribe online at ValueLine.com.
Fair enough. I think that's about it. Sharif, are you still there?
I am here. Alan and Charlie, great job with the questions. I just want to thank everybody for participating today and for submitting your questions. And as Alan touched on, if you do want to subscribe, if you have any questions about the different tiers of subscriptions that we have, the different services and products that we have, you can visit ValueLine.com, or you can also call 1-800-ValueLine. So thank you, and at this stage, I am going to turn it over to Andrew. Thank you, Andrew.
Hi, everybody. Thank you for attending today's event. You may now disconnect your lines and have a great day.